Hello, welcome to the Fibers of Life and Business. I'm your host, Joe Watkins, and today we're talking about financial margin. We're talking about financial margin through an investor mindset. Last episode, we talked about a little bit about margin. And so you've got a little definition on that. And I thought, well, it's time to get into the nitty gritty and do one of the fibers in depth. And we're going to do finances. It's the one that's probably the most easy for me to do. It's the one I've done well in my life. And I want to share with you today the principles that I've used over the years to help me create financial wealth. And in doing so, I think the same principles can be used for you to create margin, and margin over time creates wealth. So that's what we're going to do. And we're going to jump right in here. So I've got some notes here I'm going to look at today. Before we get started, I'm going to do this. If you stay with me to the end of the show, we're going to get to a place where you're going to get the principles I'm going to talk about in a Fibers financial margin playbook. Okay, you're going to get that. I'm going to give you an email, and you're going to have to do one other thing for me, and you're going to get that. And it's probably going to be a better representation than what I can tell you today. But these are the things that have really helped me over the years. Now let's talk about margin one more time. When I say financial margin, margin is more than the need. Okay. If I have enough money to pay my bills every month, but I have nothing left over, then I don't have margin. I have just enough. If I have margin, then I can create a gap between me and maybe the next paycheck. I take that money and set it aside. I have margin, right? And margin is not necessarily about how much you make. It's more of a mindset to create margin. That's what we're going to talk about today. So let's dive right in. I'm going to first say, here's some questions I want you to be thinking about. And these are margin questions. And how you respond to these, you're already going to know how much this episode is going to matter to you. Do I think about money constantly or mostly during scheduled planning time? Would I feel calm for at least 6 months if my primary income stopped today? There's a Dave Ramseyism for you there. Do unplanned purchases make me uncomfortable or excited? How stressed do I feel when debt comes up in a conversation? How often do I buy things and feel I deserve a reward? Can I delay a purchase I want in order for a future need, to prepare for a future need? Am I confident I could handle a major unexpected expense without panic? Based on those questions, you kind of know, right? It gives you a little bit of a measurement of where your financial fiber is, of where your margin is. This is all about creating financial margin. And this is just going a little bit of a deep dive on here's some practical things to help you think differently about creating financial margin. The 6 practical financial fiber mindset changes here. Let's go number 1. This is, to me, is the foundation of the episode. If you don't remember anything else, you remember this. And have an investor mindset in every decision, in every purchase decision. Now that sounds, yeah, that's cool. When I go buy a rental house, I'm going to have an investor mindset. That's not what I'm saying. I'm saying in every purchase decision. When I go buy a jar of peanut butter, I'm going to buy the $5 peanut butter over the $10 peanut butter if it's a choice of 2 and I like them both, even if I like the $10 one more. Because decisions like that compounded over the whole grocery bill might save me $50 on that one grocery bill. If I do that through 52 weeks of the year, how much money did I save just in groceries alone and had really no difference in return on investment with those purchases? And so I understand that there are differences in organic peanut butter and one that's not. I'm saying if there's 2 organic peanut butters that have the ingredients you are liking for your health, then if you can get one for 40% less and you do that across all of your groceries, that's worth a lot of money. That's putting the investor mindset on. Because at the end of the day, if I make 2 peanut butter and jelly sandwiches and it costs me half as much for one than the other, and they both taste the same and fill me up the same and have the same health consequences, then that half price one was a much better return on investment. So if anything, I want you to think about even the micro purchases you make as investment decisions. So that's mindset change number one. Think about everything as an investor purchase. Now, the payoff is pretty huge. It's not just numerical, right? It's emotional. It's relational. It can be spiritual. When I make good decisions about my finances, it can free me up in other areas, right? It can free my mind up. It can make my relationships better. When I have margin, financial margin in my life, I'm much more free in my relationships. I don't feel stressed when I get home. So these micro margin decisions is what creates big margin. And this is really the whole deal behind the fibers of life is, everybody's looking for the big quick fix. I think it's the opposite. I think it's micro mini fixes all along the way, little mini things you can do, added up over time that create significant margin and significant choices and a much better life well lived. So that's what we're doing here. Kind of a quick example. If you have buyer's remorse, you probably made the wrong financial decision. That means your return on investment did not match the cost. There we go. I'm going to give you one other thing that y'all can relate to. If you own a rental property, if you have a rental property, and I had a property management company for years, we got to 1,700 properties. I had so many conversations with investors or would-be investors. I could fill a podcast for years, but it's funny to even call some of these folks investors. I'm not beating them up. I'm saying the truth is they weren't, okay? Because when I tried to get them to spend $15,000 on a rehab or on a improvement to the property that I could actually show them could bring them another $3,000 a year in rent, and they treated the $15,000 like a sunk cost. It's not. You're making a $15,000 investment to get $3,000 additional in rent. That's a 20% return on that $15,000. That's not a $15,000 expense. And so it's just a different way to think about money in general. Is you're always investing, right? And there's always a return on investment. So I wanted to give you that one. And actually I'll give you one more because this happens in almost every family. When we go on family vacations, undoubtedly, we probably look back on many of these and go, we spent too much on that, or we should have done that. That wasn't worth it. Well, here's what I know. And I think this is what you'll find out is that as a kid, when I think back on the vacations, and as my kids think back on their vacations, they remember less about where we went and what kind of hotel we stayed in and what kind of food we ate. They remember the time we spent and that we went to Orlando and we did it yearly. That's what they remember. And so you can really find ways to create the same experience for a lot less money. And that's how an investor would think about spending their money. So that's just another example. All right. So number one is have an investor mindset in every decision. Number two is know your numbers. Are you aware of your numbers? My guess is a lot of you are not aware of your numbers. So what do I mean by that? Commit to memory things like, how much is my car payment? I ask people this, they don't know. What is my house worth? I don't know. What is my check that I bring home every month? All they know is what they make every 2 weeks after tax. They don't know what they make for their gross income. What are my grocery expenses for the month? They don't know. What is my average electric bill? They don't know. They don't know their expenses, and they don't know their income. Well, how in the heck can you create financial margin when you don't know your numbers? You got to know your numbers. A good business person, in fact, most business people that I've met that really do this well, they know their numbers. They know exactly. They know that they spent $89 on the light they just hung on the wall, right? It's crazy to me. I mean, guys that run, very large organizations know their numbers better than anybody else. And so if you want to think like an investor, you got to know your numbers. So start by learning things like, maybe just a balance sheet. Do a balance sheet. Put assets on the left side, put liabilities on the right side. I own a house, what is it worth? I own a car, what is it worth? I own jewelry, what's it worth? Cash in the bank, IRAs, 401ks, whatever. These are my assets. Put value to it, add it up. Right side, liabilities. Oh, X on the house, X on the car. I got debt on my credit cards. Boom, there's my total liabilities. Subtract it out. If it's a positive number, you have a positive net worth. If it's a negative number, you are negative net worth. You practically are insolvent. And so know what you're worth. And that's a good baseline for you to track over time, because you need to see that grow. You create financial margin by seeing your net worth grow, right? So these are just basics. Know your numbers, and you will begin to have a concept of growing financial margin. Now, if you know your numbers, now what's next? You got to organize your numbers. So number 3 is organize your numbers. What does that look like? Spreadsheets can be used. QuickBooks can be used. Monarch Money is a financial software that I've used in the personal world. It downloads all your stuff into an app, and you can literally look at every single transaction. You can automate those transactions and put labels by them. And so very quickly, you can start to create a little bit of an understanding of where you are and what you're spending. So through organizing your numbers, you will know your numbers. So maybe organizing the numbers comes first. Get your numbers in a place where you know what's happening, and then you can actually know your numbers. And so, I know recently I looked at Monarch Money and just looked through there, and I found an expense that I could not believe that's what we paid. They went up on me. I had no idea. It was an automatic billing, and I called and got it knocked down. Why? Because I was looking at it in a very easy access way. Organize your numbers is critical. When you organize your money, your income turns into margin. I mean, that's sort of the bottom line here. So let me plug here. We talked about the financial margin playbook. All the stuff I'm talking about is what's going to be in the financial margin playbook that you're going to get a free copy of when you sign up with email. So we'll talk about that at the end. Just want to bring that up again. Number 4, eliminate debt on non-income producing assets. Eliminate debt. And debt on a car is a non-income producing asset, unless you're in the cab business or you actually are using it to make money in the business. But when you're talking about your personal finances, cars are almost always non-income producing, other than getting you to and from work. So does a $20,000 car get you to and from work as easy as a $100,000 car? It sure does. It does. And so, all in the context of what you're earning, obviously, on what you might want to spend on a car, but it's a non-income producing asset. Anytime you fund lifestyle of any kind, RVs, boats, those are big things. But if you're buying a new guitar, I love guitars. You buy a new guitar on a credit card. You go buy groceries on a credit card. You start buying things on credit cards because you don't have the money accessible. This is funding lifestyle on debt. This is unacceptable in a world where you're thinking like an investor and you're growing margin and growing wealth. Okay? You can't do it. Now, in a business, I may fund a piece of equipment with debt, and that equipment's going to return money back to me. That's okay debt. That's okay debt. Debt on your house is okay debt, but lifestyle debt is just not okay. You got to get rid of that stuff. Get rid of the I deserve it mentality. This I deserve it approach. I mean, all of the retailers out there are saying, you deserve it. You deserve it. Of course they are. They want you to buy their stuff. And how has that consumer growth happened in America? Because they figured out that if they gave you financing or cheap financing, you'll buy more. You know, Americans owe more money than anywhere else in the world. We are the largest consumers per capita anywhere else in the world. And so stop being a consumer. Consumers go broke, investors grow wealth. Another thing you should write down: consumers go broke, investors grow wealth. Okay. So lifestyle debt quietly erodes financial margin. Okay. That's the takeaway here. All right. Number 5, create leverage around your time. This is more in the business side, but I think you can look at this in your personal side as well. So what does that mean? That means time is your most valuable asset. So when you have margin in finances, it also buys freedom. It buys freedom from being locked down. It don't just buy stuff, it buys freedom, it buys time. And some of the keys for this is think about things you can do that are work, pay, rather than work, pay, work, pay, work, pay. Anytime you trade time for dollars, then you're not multiplying, you're not creating leverage, right, with your time. And so, so examples of this, well, owning a business is definitely an example, a real business where you have people that actually earn income for you that makes money without your presence or while you sleep. Okay, that's creating real leverage. Virtual assistants, CRM systems, which are customer relationship managers. Anything that can be automated through AI can radically buy back time. You can get people involved, take over a portion of the business, take over some of your key responsibilities, find that key man or key woman that literally becomes the replacement of you. That's what Truett Cathy did in Chick-fil-A. The owner-operator model was his design to replace the person in the next store with a guy just like him. And he wanted the model that would incentivize that person. Maybe think about that in your business. So even at home, if I can have somebody clean my house and I can pay them less than I can go make, maybe I can make twice as much and you don't get any joy out of cleaning a house, it creates stress and anxiety, then pay them. Now, if you enjoy cleaning your house, don't pay somebody, because that actually gives you other rewards and other returns. So these are just ideas. The anchor line here is if income stops when you stop working, you don't own a system or a company or a business, you own a job. If income stops when you stop working. Okay. Number 6, be a good steward of your business. Be a good steward of your finances. What does that mean? That means your business is not an ATM card. It probably should mean that your personal account doesn't act like an ATM card. If you have a real budget in place, then you don't treat your personal business or personal account as an ATM machine. But specifically for your business, put yourself on a fixed salary. Give yourself a W-2. Live off that. Let your business grow profits so you can take profits to reinvest to grow more profits, right? Add people that can take something away from you. You can grow, creates time. This is one of the best things to do if you own a business. Of course, separate your personal and business finances. Reinvest those profits intentionally. Serve the business so it can serve you. This was a huge thing for me. About five or 7 years ago, I partnered up with what became one of my best friends in Travis, and we partnered up in business. And it became clear to me that one of the principles we needed to really put in our mind and shift hard was that we need to treat our business like a separate entity that we were serving rather than it serving us. Because if it's always about serving us, then it's an ATM machine. But if we can create a business and we can serve it to the place where it becomes the valuable piece, where it becomes more valuable while we're still getting our bills paid, it becomes and grows its own entity that can not only serve us, it serves our customers, it serves our other people. We can bring key men in. I mean, another way to look at this is when you have a child and you raise a child, don't you want your child to grow up into an adolescent and then to an adult? In our purpose as a parent to figure out how to get our kids to be self-sustaining, to be people that do the right things when they go out in the world and they're producers in the world. Well, they only do that when they become an adult. So imagine if you thought about your business much like you did when you raised your kids, right? I want to figure out how to get my business from a kid stage to an adult stage where it's self-functioning and it's making money for me. So be a good steward of your business. Be responsible. Don't pillage your business. Raise that business up responsibly, just like you would raise your kid. So that's number 6. Be a good steward of your business. When you tie all this together, I'm going to state this again because you need to write this down. This is the key takeaway. Consumers go broke. Investors grow wealth, not just financially. Investors, if you learn how to invest, you're investing in every fiber. But even when you invest in one fiber and I grow wealth financially, I'm going to create freedom in my relationships, freedom in my emotions. Gives me more time maybe to read and grow intellectually and spiritually. So consumers go broke, investors grow wealth. It's key. So this week, I want you to answer 3 things. You need to do this week. If you don't come out of an episode and have a couple things to do, then maybe we didn't get it right. So let's do this. Answer the margin questions at the beginning of this episode. Answer them honestly. And you can go back and listen to it again, but did you have stress over those questions? Do you need margin? Can you go 12 months without a job, without an income? And these are just real. Does debt get you stressed? Those questions. Answer those honestly. Write down your numbers. Just do a simple balance sheet. Write down your assets, write down your liabilities. Get Monarch money. It's $100 a year. It'll be the best $100 you spend. If you actually look at it, you'll be shocked. You'll probably save $100 in the first month when you find out what you're spending. And then the most important thing of the entire episode, and it goes back to that word investor. You have to treat purchases, every purchase, like an investor. That's the mindset change. Every purchase is an investor purchase trying to create a good and solid return on that investment. Okay, great. So now let's get to what we talked about, the financial margin playbook. 2 things you have to do. First, you have to subscribe to one of the places where the Fibers of Life and Business is. It's YouTube, Spotify, Apple, Amazon, it's Instagram, Facebook, it's everywhere. Okay. But the long form podcast is going to be your best way to get all the information. Do a subscription and then send an email to joe@fiberspodcast.com. And in the subject, I want you to put financial margin principles. Okay. Let's say it again, joe@fiberspodcast.com and financial margin principles in the subject. You do that, I'm going to reply back with a nice little copy of the 6 fiber financial margin principles in a much easier version to follow than even this podcast. So listen, that's it. I thank you for watching the Fibers of Life and Business. I'm your host, Joe Watkins. Come back and see us next time.